HP Incorporation HPQ Beginner's Guide. If you have ever used a laptop in a college library or watched a printer in an office spit out pages, the machine very likely said HP on the side. HP Incorporation, ticker HPQ, is one of the two largest PC makers on the planet and a dominant force in printers. Today we walk through what the business does, who it competes with, and why it has looked the way it has over the last 5 years. Quick reminder, this is purely educational, nothing here is investment advice, and we stay away from stock price and valuation talk. So, what does HPQ actually do? HP Incorporation has two big businesses, and they are very different. The first is personal systems, which is the fancy name for laptops, desktops, and workstations, basically PCs. That segment brought in about $38.5 billion in fiscal 2025, roughly 70% of total revenue. Within personal systems, about 71% of sales are commercial, sold to companies and governments, and 29% are consumer. The big new thing here is the AI PC, a laptop with a special chip called an NPU, a neural processing unit, that runs artificial intelligence tasks directly on the device instead of sending them to a faraway data center. AI PCs are now over 35% of HP's shipments and growing, and they sell for higher prices than traditional laptops, which lifts the ASP, average selling price, basically the average price tag per unit sold. The second business is printing, which brought in about $16.7 billion, roughly 30% of revenue. The key number is that 65% of segment sales come from supplies, industry speak for ink cartridges and toner. Another 28% comes from commercial printers and 7% from consumer printers. That mix matters because supplies are extremely profitable, and we will come back to that. HP also runs a software platform called the Workforce Experience Platform, or WXP, that manages about 50 million devices for big enterprise customers, the brain that lets a company's IT team keep tabs on every laptop and printer in the building. HP buys CPUs, central processing units, the main chips inside computers, from Intel, AMD, and Qualcomm, and memory chips from Samsung, SK Hynix, and Micron. Then assembles and ships finished products to customers in more than 190 countries. So, who does HPQ compete with, and how does it win? HP's competitive moat, investor speak for the durable advantage that keeps rivals from catching up, is rated narrow, not wide. In PCs, HP is either number 1 or number 2 globally, trading the top spot with Dell and Lenovo, with Apple a major rival in the premium consumer segment. The honest reality is that a PC is largely a commodity. All four companies offer similar machines with similar chips inside, so HP cannot charge a big premium just for the logo. What HP does have is scale, enormous purchasing power with suppliers, and a deep enterprise sales force built over decades. WXP, that 50 million endpoint platform, also creates switching costs, the hassle a customer faces swapping to a competitor. Once your IT department is running everything through WXP, ripping that out is painful. In printing, the moat is stronger but eroding. HP's installed base of printers sitting on desks and in offices creates what is known as the razor and blade model: sell the printer cheaply, then make most of the money over the years on consumables, the ink and toner. That supplies business generates about $10.9 billion a year at margins above 18%, roughly 3 times the margin HP earns on PCs. The catch is that the installed base is slowly shrinking as offices go more digital and third-party companies sell cheaper compatible ink, eating into HP's share. HP is countering with subscriptions like the All-In Plan, where consumers pay a monthly fee for printer plus ink as a service. That sub-business is growing double digits, but not fast enough yet to fully offset the secular, meaning long-term, structural, decline in supplies. What are the key drivers for the business over the past 5 years? 3 forces have shaped HP over the last 5 years. First, that razor and blade printing model. Even though printing revenue has been declining 3% to 4% a year, the segment still throws off over $3.1 billion in annual operating profit because supplies are so high margin. Printing has been the cash engine quietly funding everything else the company does. Second, personal systems revenue swings have been driven by two big cycles. One is the Windows refresh. When Microsoft pushes a new version like Windows 11, companies upgrade their fleets, which means buying new HP laptops. That Win 11 refresh drove 6.5% PS revenue growth in fiscal 2025 and 11% growth in the first quarter of fiscal 2026. The second cycle is AI PC adoption, where business customers want machines that can run AI features locally. The catch is that PS operating margins stay thin at 5% to 6% because HP buys a lot of memory chips, DRAM and NAND, and memory prices have roughly doubled into fiscal 2026. Memory and storage are now about 35% of the bill of materials inside a PC, up from 15% to 18% historically, and HP cannot pass all of that through to customers without scaring off demand. Third, HP has been running an aggressive cost-cutting program. The earlier fiscal 2023 plan beat its savings targets, and the new fiscal 2026 plan targets about $1 billion in annual savings by fiscal 2028. A lot of it through AI agents automating things like order entry and sales returns. On top of that, HP has been buying back its own shares heavily, shrinking the share count from roughly 1.1 billion to about 930 million over 5 years. Fewer shares outstanding means each remaining one represents a bigger slice of the company. To wrap up, so when you zoom out, HP Incorporation is a global PC and printer maker that earns most of its profit from printer ink and toner, uses the cash to ride PC refresh cycles and return money to shareholders, and is now leaning into AI PCs and AI-driven cost savings as its next chapter. As a learner, the things to keep an eye on are AI PC adoption. Is it climbing past 50% of shipments, DRAM and NAND memory prices, whether the printing subscription model can stabilize that segment, and the CEO search after Enrique Lores stepped down. Again, this is purely educational, nothing here is advice, and from here you would go deeper into financials, competition, and the broader PC and print market on your own.